Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Zach WalkerLieb, gave us an overview of the real estate market for 2023. Anthony, what was a takeaway or two that you had?
Man, Zach's a wealth of knowledge, and there was some great information there. And kind of, if I had to pick a couple things, it would be we need to think long term. Like right now, the market is in a unique situation, but hopefully our listeners are long-term investors. So we need to look at the deal now and what the numbers are, but we also need to be able to look long-term. And, we've said oftentimes on this podcast that they're not building enough homes to keep up with the current supply. In addition, we have the next generation, the millennials. Not only are they now starting to buy homes or in that position to buy homes, but that generation is bigger, much bigger than Generation X. Then you throw on Wall Street's getting into this game. Wall Street's going in and buying these single family homes. So there's going to be supply and demand issue. And I think it's going to be possible this country is going to turn into a world of renters. Things are going to be so expensive. So let's put our long-term vision goggles on and make sure we're looking at that vision when we're deciding if or not to buy right now.
Yeah.
What would you add there, Cam?
Wall Street, they're not just buying one or two houses, they're buying neighborhoods. Right. Zach shared some articles with us. We'll put those links in there, but very interesting at the scale in which they're doing that. But my two takeaways, real quick. Number one is you touched on it. The demand for entry-level homes is through the roof. And so I am going to go out there, start a construction company and see if we can build some entry-level houses. And then the second part of that is that, man, there's a lot of people that are getting priced out of homes, whether it's due to just rising prices in the market and or the interest rates are not helping people. And so the norm, right, if you're approaching this from an investor, is that if in your local market you're getting priced out, you've got to think nationally, right? You've got to start looking in certain markets that are affordable and attainable for you, because then he talks about just the demand that we're going to have over the next 10 years. And so I think that's a skill. That's something that you guys need to look into. So those are my two takeaways. And I hope you guys will enjoy this interview with Zach WalkerLieb. He is a partner at Willow Manor Brokerage here in Las Vegas. But again, his network expands locally, nationally, and gave us a great perspective on some of the market conditions we can expect for 2023. Enjoy this episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Zach, we want to thank you again for coming back, man. We are excited to have you. And for those of you listeners that aren't familiar with Zach, which you should be by now, because I think he's kind of become our residential real estate expert here. Zach's an accomplished real estate agent and one of two managing partners over at Willow Manor Brokerage here in Las Vegas. And your network expands, locally, nationally, but also internationally. And we brought you back to provide some insight on the real estate market here for 2023. Zach, thanks for coming.
Yeah, thank you guys for having me. This is my favorite podcast to be on. The only thing is I'm always a little bit intimidated before I get on because I know that Cameron's going to look a little bit prettier than I do. And it's tough for me to be on the same screen as you.
It's a big shadow. Anthony has to deal with it every day, so you'll get used to it.
Zach, might I just chop liver here?
Zach, hey man,
we look the same, buddy.
Hey, before we get started, let's if you could tell us and our listeners a little bit about yourself.
Yeah, so I've been in real estate for 12 years now. Previously been one of the top 30 under 30 realtors in the world and one of the top 30 under 30 realtors for the National Association of Realtors. Have now been one of the top 40 under 40 here locally several times and made their Hall of Fame. one of the top 1% still every single year internationally for realtors. Now we have started a team here in Las Vegas called Willow Manor. We focus mostly on luxury, and but we help everyone, especially investors, and then that's why we've got great insight into the market, and we can help everyone achieve their real estate goals. So I'm born and raised in Las Vegas, got a lot of great connections here and great connections around the country as well.
That's quite the track record in real estate. Yeah, it's impressive. How did you get started in real estate? It
was happenstance, man. I was studying finance at Santa Clara University, and I was kind of lost. I didn't know if I wanted to be in finance my whole life, and it was kind of scary leaving college at that time, because I interviewed with Goldman Sachs and UBS and got jobs. And I got jobs in 2011. They offered me jobs. So the market was terrible. They weren't really hiring anyone. And I ended up getting a job, and I asked the question, do I want to be behind a desk working 80 hours a week and living in the Bay Area for my whole life? And I was like, nah, that's not it, man. And so I came down to Las Vegas and I interviewed with a broker, and he said, well, your life's going to suck for probably 3 years, but your success or failure is all on your shoulders, and the sky's the limit. And I said, well, that sounds like a deal, let's do that. And that's how I got into it. And then I slowly grew and made it my passion and became a master at it over time. But for the first little bit, it was just happenstance or providence.
Awesome, man. How'd you get into luxury? Like, is you hear people get in residential, commercial, but what does luxury kind of real estate to mean? Is that a tier? What is that?
Yeah. So I think I started kind of naturally falling into luxury because it demands both a deep understanding of the market and other financial vehicles, and really the economy at large, the global interactions that are occurring influence luxury in a different way than they may influence the standard home. And so having an education level and an ability to communicate with people at that level was probably what kind of has led me into that pathway. We still provide the same service to everyone. It's just, I think, a knowledge base, really.
Absolutely.
Well, let's dive into this, man. Like the real estate market in general has really changed these last 6 months. So, Zach, how do you see it like right now? Not a video of the future, but we take a snapshot right here, kind of with some of your wisdom.
We've had the craziest market shifts. People who have been doing this for 30, 40 years would say that this was the craziest market change they've ever experienced. So more of a shift than what happened in 2008 has happened over the last 7-8 months, let's call it. So we went from white hot, crazy market to almost dead stop for a period of time. How that occurred was the Fed increased interest rates rapidly, the fastest increase in interest rates they've ever done. And that deeply impacted the mortgage market. Obviously, mortgage rates went up. The buyer pool got shocked. Recession conversations started entering the world, and people started being concerned about the future of the economy. Were houses going to crash in terms of their value? How strong is the Fed going to go here? Are they going to go way out of their mind and just collapse us? Or are they going to be tempered and be even keeled? And a lot of that uncertainty still remains in the market. There's still a lot of people who are very uncertain about the direction, myself included, to be honest. There's signals from all sides. There's these really strong numbers being reported by some major companies. And at the same time, they're laying off tens of thousands of people. So this week, we had a huge week. The Fed announced they're going to continue raising rates for at least the next 3 cycles with them. And we also had stocks, some huge companies report their earnings. And after the Fed said we're increasing rates, stocks went up. But the manufacturing index, the industrial index here in the United States, just declined to under a number of 50. So I think it was at 47. What that signals is anything above 50 shows expansion in the market sector. And then anything below 50 is contraction. During the Trump years, it was always above 60. It was a phenomenal number. We were always expanding. Since the Trump years, we've slowly been decreasing, and we are now at 47. So what that signals is contraction in industrial and manufacturing. However, we've got China now reopening their economy and saying, okay, we're done with the zero COVID policy. We're going to reopen back up to the world. What that means is that trade with them is going to go boom and go crazy. So that's going to make inflation harder to tamper down. There's going to be more demand in the world for oil. There's going to be more demand in the world for resources in general. And there's going to be more demand for trade, potentially. So there's a chance that inflation goes again and does another run up, which is what happened in the 1970s. The Fed tapered down a little too fast, and then it roared back forward at a greater rate of inflation than their initial period of inflation. And so the Fed is aware of that. The world is aware of that. And now as China's reentering the global economy in a serious way, we could be facing serious inflation. Non-farm payroll increased. So we're seeing excellent numbers. Again, GDP in non-farm grew at 3%. So we're seeing incredibly optimistic numbers in so many different ways. And then we're seeing terrifying numbers in other ways. Inflation is a terrifying thing. Layoffs is terrifying. Debt is extremely terrifying. That is the looming crisis of our country. If you've heard Stephen Druckenmiller, he's similar to Warren Buffett. He says, and he lays it out how it's going to happen. We will become insolvent in just a short period of years. And so debt as our country in general is burdensome. And in the immediate, it's also burdensome. So that's kind of what's going on. It's just pure chaos, and we're getting it from all angles. The consumer is aware of that. And they're going, should I buy into this market where it's absolutely insane? And interest rates seem to be at a high rate. And I don't know if in a year or 2 years, the Fed is going to come down in their rates and I should buy then. And sellers are going, hey, I bought sometime in the last 10 years. I've got a 2% interest rate. I've got a 3% interest rate. I've got a 4% interest rate. And I'm paying $2,000 a month for a home that's worth $800,000 now. Why would I go buy another house, whether I'm upsizing or downsizing? Why would I buy another house? Let's say it's $600,000. It's going to be more expensive than my $2,000 a month payment on my current $800,000 house. So why would I transfer that? That's the conversations that both buyers and sellers are having. They're going, should I be entering this market? And so if I were to define this current market, it's a period of uncertainty. That's what we're experiencing right now. It's a serious period of uncertainty. That will be cleared up in a very short time frame. We will know in the next 3 to really 6 months how everything's going to fall, what the chips are going to look like. We'll know how serious inflation continues to be. We'll know what buyer demand looks like. Have we entered a recession? Have we not entered a recession? and kind of the lay of the land. And we will know that. And then I think that there will be a return to activity that isn't there at the moment because of uncertainty. However, the rate increases have wiped out a portion of buyer interest. So we saw in Las Vegas, for example, we had 4,000 to 4,500 single family home sales every month. We decreased to 1,500 single family home sales in the last 30 days. So a third. We dropped significantly. What that impacts is all real estate agents, they're not selling anymore. Mortgage lenders, they're not selling anymore. Title and escrow, they're not doing business anymore. So there's going to be layoffs in the real estate industry simply because of the volume that exists. If you were selling 10 homes, you're selling 3. If you were selling 3 homes, you're selling 0 or 1. You're gone. You're not surviving right now, which is a great thing for people who can get in and who have saved money. So this is where you get into the investment conversation. If you've got cash, you can make some crazy deals right now because the sellers that are selling are really pressured. Typically, they're wanting to sell. They need to get out. They're moving, they're job relocating, they're doing something. They're willing to negotiate their sale. So if you're investing in real estate, you can get them to pay for your closing costs. You can get them to make the home brand new with repairs, in great working order. You can do a lot of good things that you wouldn't have been able to do in other markets. So if you do a rate buy down, for example, as a buyer, you can take your rate that's at 5.5%, 6%, something like that, buy it down to 4.5%. That's a phenomenal rate. So you're telling me I can have lower prices than were at the beginning of 2022, and I can get a 4.5% interest rate by way of seller buy down on my rate? I'm not even paying for it. Absolutely. Let's do that. Why wouldn't you? Now you lock that in for 20, 30 years, you've got a killer rate and we're going to appreciate. So what do I see happening in the next year, 2 years? I think we're going to soften still. That's my personal opinion. There's people who disagree with me. There's people who say, we're just going to keep roaring. However, if you look at income, median income to median home price, and this is a national issue, it's more expensive now to buy a home than it was in 2007, right before our collapse. That's a concerning number. That's one of those concerning signals out there, right? So all this optimism, all this good stuff, and then you've got this very concerning data point that it's more expensive now, median income to median home price, to purchase a home than it was in 2007. In Las Vegas, we're not that high, but still a concern.
Now, when you say that, I would think that is not a good sign, which would mean maybe it's not a good time to buy. That's that's my first reaction, because something's going to have to change.
Yes.
Maybe interest rates will get lower. Yeah. Go ahead.
It's the whole country is experiencing what California experienced. California is a great example of what we're about to experience. Californians all in the 1990s and early 2000s and 1980s were going, this is too expensive. It cannot end. It has to end. Sorry. I can't afford a home. And then they just saw it go. So they're like, oh my God, I bought my home for $100,000. It's now worth $500,000. Like, how can this be? And then 10 years later, it's $1 million. And they're going, no, this is unaffordable. We can't continue this. This is madness. And then it's $2 million in another 10 years. That is unfortunately what's happening across the country in major cities. And we have not been able to stomach it yet. So yes, on a median income to median price, it's expensive. It's bad, but it's likely over a 10-year run going to get worse. So in the 1 to 2 years, man, I wish I had the crystal ball. I'd be a billionaire. I'd be a billionaire, as would you. If I could tell you exactly what's going to happen, we would make crazy money. What I will say is there's investment opportunity right now. So if you buy something, you're doing it cash or mortgage, however you're looking at it, as long as it's cash flowing well for you and you can afford it, phenomenal time to buy. Phenomenal time to buy. Because what's happening on a national scale, and I'll use Vegas again as a good proximity for what's happening. So last year in the $0 to $500,000 price range, 48% of that was purchased by cash investors. Okay. We don't build in Las Vegas $0 to $500,000 homes. We build $800,000 homes. We build $1 million homes. That's our new build communities. We're not restocking that $0 to $500,000 home inventory. So what's happening is you have this available amount of inventory right here. Okay. And then every year it's going like this because it's being half purchased by investors. And then again, and then again, and then again, and then again. All the real estate is being eaten up, all of it, in the median home price arena. And so that pressure, that demand is being pushed into the higher price points. So if everything that's $400,000 is being eaten up, well, guess what? They're going to extend their budget to buy the 500,000. And those 500,000s are going to extend their budget to buy the 600,000. So the supply and demand issue that we are in a serious crisis on will last us a decade or more. So from 2007 until 2019, we did not build enough homes. We went from building an incredible amount of properties to nothing. I think nationally it was like we'd build, so let's use Vegas because I know the numbers for sure. We would build between 25 and 30,000 new homes per year in 2000 to 2007. That's what we were building. And then after that point, we were building 5,000 to 7,000 homes for the last decade with more people moving into the city. So 25,000 to 30,000 new homes with less people moving in. And over the last decade, we've been building 5,000 to 7,000, 8,000 with more people moving in, with our population almost doubling. The inventory crisis that we have created by builders not building and regulation existing that should not exist, and us owning our land, that's another issue, is causing the housing crisis. It's what's causing homes being unaffordable. If builders could develop into areas in Nevada, if we owned our land around Las Vegas, if we could buy the cheap land, builders could build the cheap land. That's the problem. Land costs is so ridiculous. Same thing in California. They ran out of land. And that's why you have LA just became this sprawling, massive thing, because the only way to make it affordable was to go further and further and further and further and further away. And everything in the pockets became more and more and more expensive because of inventory issues. They do not have the land and that will exist for the next 10 years in all major metropolitan areas. So we are going to have that crisis. So if you bought now and prices went down 10% more, 15% more, it's going to be double in 10 years probably. So I mean, that's the unfortunate circumstance. Maybe not double, but it's going to be much higher. So if you're a long-term player, play the game as long as you can afford it.
Well, so what I heard you say kind of to open up with was that there was a lot of pressure to keep people on the sidelines. And then what I heard you say kind of there on the second part of it was, listen, this inventory problem is not going away. It's going to be here for the next decade or so.
Yep.
And to me, that sounds like, man, you better buy as much as you can right now and just ride that inflation wave or that demand over the next 10 years.
Let's say this, okay? The dollar's not gaining value. It's not gaining value. They're going to keep printing, okay? They're going to keep printing over and over and over again. whether they do it in the trillions or not, that's the question. But they're going to keep printing. The dollar's going to keep losing value. So if you can buy something for $300,000 and you get a rate of 5%, that's less than inflation right now. If you transfer your money, whether it's sitting in a bank or it's sitting in a property, it's less than inflation. You're making money simply by owning a property. That's madness. I don't know if that's happened before. I don't know the data on that. That is crazy numbers. You can get a mortgage 30%, even though they're high, even though mortgage rates are high, that's less than inflation. You're losing 6% of your dollar every year that you keep it in the bank right now. And it was higher than that. Realistically, it's much higher than 6%. So if you had $100,000, you're going to lose 6% of that, compounding every year. So inflation, just like investing, is a compounding issue. So you invest at 7%, it's a compounding thing, right? You lose your dollar every year at 6%, it's 6% compounding. So
and we've talked about it. Cameron's big on hair care in general, but also how the importance of words, right? And we look at inflation, we're kind of throwing that around willy-nilly just to say, well, prices are going up. But really the economic definition, and I am generalizing it, is it's that loss in buying power because of the government is printing more dollars. More dollars are out there. And Zach, I know we had the conversation that since 2008, there's 3 times the amount of money in circulation in the US compared to 2008, like 3 times. Yeah. And I think a lot of people are pointing fingers at these rising prices. They're blaming COVID. They're blaming some supply issues. Those are all temporary. The market will figure that out. But all of this dollars that just got printed and injected into the economy, nobody's talking about that. That's still there. We're going to fix these supply chain issues, but unless the government destroys dollars and unprints it, which they're not going to do, like this inflation we have here, we don't like it, but I think we need to accept it. It's going to be here.
Well, I want to make a point on inflation. Inflation is a hidden tax on the poor. That's what it is. It's saying we're not going to tax you directly. What we're going to do is we're going to print the money that we're not getting from other taxes and income sources. We're just going to print that. And then by way of inflation, you will end up paying for it. So the government gets its money through the inflation of the dollar, the printing of the dollar. And then who bears that burden the most? It's the poor and the middle class. It's a hidden tax. The government says, okay, we need this money for this project. And how we're going to get that money, because we're not getting it through these tax sources, and we're not going to raise taxes on people because they're going to feel bad about that. So what do? We just print money. And then we experience inflation. And then the poor and the middle class get hit the hardest. So who's bearing the burden of this? It's the people that were right on the cusp of owning a home and now cannot afford a home. And we talked about this too. JP Morgan is sitting on $1 billion fund right now. $1 billion fund to buy residential real estate across the country. There are several private equity firms and venture capital firms and banks that are amassing billions of dollars to purchase residential real estate right now because they realize how strong of an asset class it is. There's incredible write-offs. You could depreciate the property. BlackRock just wrote off $1.7 trillion from their real estate portfolio. That's insane. BlackRock just wrote off 1.7 trillion. So they can do all this financial magic, own the asset, write everything off, and the American dream is being eaten by these guys. The problem is they were the first to receive this free money from the government. They got immediate access to the trillions of dollars that were printed. And then they lent it out to the American public for 3-4%. And we were all so happy about it. We're like, oh my God, I'm getting money for 3%. Well, they got it for 0. And then they lent it to us. And then what are they doing? They're amassing billions of dollars to buy our properties with it. This is not capitalism. This is not a free market. This is not how things should work. This is cronyism. You know, the definition of fascism is the merger of corporations and the government. That's what's happening. These guys all sit in the same room. They have the same incentive structure, and they're crushing the United States and the American people. Someone needs to start making a stand, because it's not good. And here's the problem. You have all these good intentions with people that are in legislature, state legislatures, Congress, whatever it is. They're seeing all this happen, and now they're going to make regulations to try and stop it, and they're just going to screw the middleman. The problem is not that this is happening. It's a natural causation of the incentive structure that's existed. They got free money. Why wouldn't I buy an asset with it that returns 8% per year and I get to depreciate it and write off my taxes? Of course I'm going to do it. Of course I'm going to do it. That's the problem. Don't regulate and now screw all the middleman or all the middle income people or the average real estate investor. So, you know, we've got a lot of problems as a country that we've got to fix. And unfortunately, the legislatures that are tackling this issue are probably going to go about it all wrong and create a worse mess. The issue is the Federal Reserve, the printing of money, and the destruction of our own money as a people, and the destruction of our own wealth. It's being ripped away from us. We need to change course. We absolutely need to change course.
I say Zach for Senate.
I say amen to that.
Yeah.
But Zach, I agree with 100% of what you said there. But what do we do? Like, what options are available to us? Right?
Protect you and your family. I mean, that's really it. You guys have such a great model that I think people should be leveraging that more. I think that become your own bank, right? That's what you guys talk about. Become your own bank. Become financially free and do it as fast as you possibly can, because it's coming, baby. And you need to protect you and your family and your own finances. So become financially literate and start investing in things that make sense, that you can afford. Don't go bonkers and start buying stuff that you can't afford. I'm not telling you to go buy real estate and just dump all your money into it and become incredibly risky. I'm saying make sure you can afford it, make sure it cash flows, make smart financial decisions, and step into the arena. Because the consequence of not stepping into the arena is you and your kids may never own a property.
So, I could see that happen. Like when you're saying this, I'm like, man, my daughter needs to buy a house. I mean, she lives with us now, and I don't want to, and I enjoy that, but I'm looking at it 5 years from now. I mean, how's she gonna be able to afford a house?
Well, let's look at California again as the example. I've got so many friends from college that still live in the Bay Area. They're 35, they're 30 to 35, 40 years old. They cannot purchase a house now. They cannot afford a house. They may never be able to afford a house. So it's what we talked about. That is what is coming to the rest of the country. Yes, some people can still afford a house in the next 10 to 15 years. Yes. You and me are going to be able to buy a house. Everyone else is, we're getting to the point where it's becoming the haves and the have-nots. And I'm telling you, man, it's the banking system, and it's the core problem that no one talks about. We keep blaming the left or the right. It's nonsense. We love each other. We're a community. We're neighbors. We need to come together. We're the team. We are the team. And the bankers are robbing us. They're robbing us, and the government is letting them do it. They're facilitating the robbing of us. So
the good stuff, Zach. I mean, I couldn't imagine not being able to buy a house. Like just growing up, I just knew, hey, once I graduated
Go
college,
talk to
I
someone in
mean,
Palo Alto. I mean, go talk to them.
I can't even imagine, but you're right. The California,
go talk to someone in New York, go talk to someone in Tokyo or Hong Kong. I mean, it's, it seems to be the nature of the beast at the moment. You got people in Hong Kong that are living in these tiny little cells. Who knows?
So Zach, normally when like with inflation rising, smart thing to do is buy real assets that are going to go up with inflation. And typically real estate is considered one of those assets. But right now we're in a unique time where we have high inflation, but the housing market's going down. Now, I believe historically those inflation and housing have kind of coincided together. Am I right? And if I am, why is it different right now?
Oh. I think that it's what we talked about. People can't afford the property and they're unwilling to take the risk. Where in other timeframes, they could financially afford the property. People are not able to afford homes. So they're not getting into real estate, and it's suppressing it significantly. I mean, we're seeing that in supply and demand and sales volume. Our sales volume dropped, not because homes have fallen in price. Mortgage interest rates have gone back down to 5%. And if you did a rate buy down, you can get that down to the low 4s at a lower price right now. But everyone's either afraid and uncertain, or they just simply can't afford it. And that's the market that we're in. So I don't think that we're going to get hammered. I don't think that a major hit is coming like 2008. That in real estate, it's not what's going to happen. But we could do another little bit. However, I've listed a couple of properties in the last 2 weeks and had multiple offers on it. I was showing a home to a buyer off market, hadn't even been listed yet. And as we were walking out, there were 2 buyers also sitting outside in a line. So you want to, I'm getting it from every side. I'm seeing incredibly positive things and incredibly negative things. And I'm trying to make sense of it all. And the only thing that I can make sense of is the core problem. That's the only thing that I can make sense of. I can't make sense of exactly what's going to happen in the future. I can just tell you exactly what the core problem is and what we need to do to fix it for the future.
Well, Zach, you made some good points about we're not building enough, right? So, but you also, I know we had a demographer on here about a year ago, and he had talked about the millennials kind of delaying on life milestones, right? That now millennials are turning 30 and they're moving out of their parents' basement, right? And so in addition to not having enough homes now, we got this new generation that is coming out. And then, as you pointed out, we have, typically, I believe single family homes on investment purpose was really more on an individual scale, where individual investors were buying single family homes. But now, as you pointed 2 articles, and we will put those in the show notes, but now Wall Street is coming in and buying up. So we're going to have some more competition. So what that tells me,
there's companies right now in Las Vegas that own thousands of properties in just Vegas. They own hundreds of thousands across the country. Hundreds of thousands of single family homes are owned by single institutions. I mean, it's crazy.
I'm going to just pivot a little bit here, do a little plug. I mean, we have a webinar coming up specifically for real estate investors. And so we had a podcast a couple weeks ago about profit first, really about easy way to keep track of accounting of your cash and be able to make quick financial decisions is by following the concept profit first. So we will have that. That'll be a private only webinar. So you will need to sign up. So we'll have the link in a link in the show notes as well. Okay. Awesome. Done with the little plug.
That's needed. Good.
Yeah.
Zach, my takeaway so far is number one is I need to start a construction company and build entry-level houses. And then number two is I live in Las Vegas, right? It sounds like these prices are only going to increase. And so if I'm looking at this from an investor's point of view, maybe I don't look in Las Vegas, right? Maybe I'm looking at other markets across the U.S.
I'll tell you what, I just talked to a guy in South Carolina. He's got a portfolio right now for $1 million. It's 14 homes. He's got homes right now for $70,000, $100,000, $150,000, and they rent out for $1,000 a month, $1,500 a month. So if you're a real estate investor and you're trying to build a little portfolio, you want to go to Las Vegas where they're starting to do crazy tenant landlord laws. And again, where legislators are probably going to do stupid stuff that's going to harm the little man and be a victory for the big guy that can adapt to all the regulation. So do you want to be in Vegas, or do you want to be in Oklahoma City? Or do you want to be in South Carolina? Or do you want to be in Birmingham, Alabama? Or do you want to be in Florida? Or do you want to be in Texas, where you know that your asset's going to be protected, the laws are going to be good, and the return on investment seems very strong?
I'm kind of hearing, do you want to invest locally or do you want to make money? That's kind of what.
Well, here's the other side of that. Here's the other side of the argument. Someone who is arguing against me would say, well, the appreciation is going to be much more powerful in Las Vegas than it is in South Carolina. So that $50,000 home, $150,000 home, yeah, you're going to cash flow it really well, but it's never going to be a $500,000 house. It never will be a $500,000 house. You know, maybe 50 years from now, I don't know. The world's different. But the Vegas home in 10 years can run. And so are you looking for appreciation, or are you looking for cash flow? That's, if someone was arguing against me on that, they would make that argument, is that maybe Vegas is a great spot to hold something. Maybe something like San Antonio is a great place to hold something. You know, there's still options out there for bigger cities that have run potential. And you don't necessarily have to go for the cash flow route. It's a personal preference, maybe.
You know, one thing we don't talk. Go ahead, Zach. Sorry.
Well, keep that in mind, but I want to touch on the development thing. Yeah, let's go.
Is that, you know, a lot of times when we're looking at buying like a rental property, we're typically buying a resale, right? Or maybe we do the burst strategy and kind of fix it up and repair, so forth. But what Wall Street is doing, they're going in and they're buying brand new homes, turning them and leasing them out. But I think people don't know that there's opportunities where you can do the same. There's a couple we've had on our podcast. I mean, there's one in Houston, and they're doing some in, I think, Alabama, where they're building a brand new home, and it's build to rent. I mean, so there's opportunities for you to do what Wall Street's doing. We just need to do some research and take action. So if this is something you're on the fence and want to know about, or want to know how to fight some inflation, let's get on a discovery call, kind of see what your goals are, and we can see how and if we can help you. Man, I did 2 plugs.
Yeah, that was good.
Yeah, we don't do enough plugs. We just kind of sit.
You gotta keep plugging, man.
Yeah.
Zach, you had mentioned development. You were going to touch something there.
Yeah. So you said two things: develop an affordable home. Okay.
Mm-hmm.
So there's a company called Boxable here in Las Vegas. You may be familiar with it because it made national news when Elon Musk said, "I own a Boxable unit." Right. So there, you can buy what they call like a casita, and it's something like 400 square feet, which is below the threshold for a dwelling unit. Okay. So you can't finance the property traditionally, and you can't even call it a dwelling unit in Las Vegas. So there's land right now where, and those things cost $50,000 delivered to you, connected with furniture inside, $50,000. So let's say I'm a developer and I want to develop a small home community and I want to do it in Las Vegas. I literally cannot get around the regulations. I've spoken to all the people necessary to do this and deliver a home for, let's call it $120,000. Where they're paying now $700 a month to live in Las Vegas in a tiny home, brand new community. That's cheaper than budget suites.
Yeah.
I cannot deliver that product because of regulation. I cannot deliver it. We talk about trying to figure out, regulating the issue. Deregulate. Give me the ability to deliver the product that is needed. Let me build it. Give us our land. Let us own our own land so that we can develop it instead the federal government owns our land. There's so many things that are easy solutions to all this madness. We could fix it like that. We could fix it so easy if we got out of debating each other and we focused on finding solutions.
Well said. Well said. Zach, what do you got? Last kind of sentiment. I don't know if you want to add to that. I think that's a great kind of ending point there. Anthony, you got anything else?
I do want to, Cameron was a little too embarrassed to ask, but we'll just ask this final question for him. How do the Fed rate adjusting the rates, how does that affect mortgage rates?
Well, mortgage rates are, they're 5, 10, 20, 15, 30. So you're approximating what rates are going to be over that time frame with a return on investment as the investor into the mortgage rate. And so like 2 weeks ago, we saw the 10-year note just drop off a cliff, signaling that everyone, investors in the market, thought that rates would be lower within 2 years and over the 10-year run than they are right now. The market thought that the Fed would reduce rates fast. Okay. So that's all considered in the trajectory of everything. If the Fed keeps rates high for a period of time, it's more likely that you're going to have a higher mortgage rate for that reason. It's more predictable that rates are going to maintain a certain level, and that in order to have a good return on your investment, you also need to have a higher rate if you're the person lending the money. So that's kind of how it's calculated in a very general sense, is people are going, if it's maintained at a high level, then I have to offer it at a higher level over a longer period of time.
Okay, perfect. Is that good for you, Cameron?
I didn't get that.
Yep, I got it.
Okay,
Thanks.
right.
Thanks for asking.
Okay.
Zach, awesome, man. Where can everybody find you, right? If somebody has additional questions, follow up, maybe they want to reach out to you and have a conversation about real estate locally or even nationally, where can they find you?
Give me a call at 702-861-4448 or send me an email at zach@willowmanorlv.com. You could also look us up online at willowmanorgroup.com.
Zach, what I'm also going to do is, I know you have like a link tree or the link in bio. So I just threw that up on the screen, but we'll have that in the show notes. That will have the direct link to everything that you're talking about.
Awesome.
Awesome. Thanks for joining us again. Once again, Zach, we will be sure to bring you back again, maybe towards the end of this year, and give us another market update.
Awesome. Thanks for having me, guys.
Absolutely. Appreciate it.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.